Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back from the long Memorial Day weekend. Hopefully everyone had a great time with family and friends, and of course, thanks for all the veterans that are out there and for everything that you guys do for us. I know there's a lot of veterans that have signed up right here at our website a long time now, and both of my grandfathers were veterans, so runs deep in our family, so we appreciate everything that you guys do, truly. All right, so today we're going to go over both the opening and closing or adjusting trades, and it's a little bit different because I didn't get back in time on Monday traveling from Pennsylvania and with traffic to do the video tutorial over the weekend, and I apologize for that. So we're going to cover everything that we did on Friday last week because some of you were able to get into those trades as well, in addition to the one trade that we closed out today, which is down here and is marked Tuesday. So again, going to cover everything that we did Friday. Everything here is Friday's trades. And then the one trade that we closed out here on Tuesday, again, had a lot of working orders today, but just not a lot of fills. So the first thing I want to start off with is the closing or hedge trade that we had in XOP, and that's this one down here. Now, if you go back in a couple video tutorials, we had actually sold a broken wing butterfly, bought a broken wing butterfly for a credit in XOP, and now XOP has moved lower. So this is almost exactly what we wanted this XOP to do, is move lower. What had happened is that we sold that broken wing butterfly that was in the call side, and we had no risk to the downside. So as XOP moves lower, now we're going to go back in and buy back the embedded call spread, which is the 80-81 call spread. Now, a lot of people got a little confused on this trade because they don't understand what the embedded call spread looks like. So first, here's a chart of XOP, and that's the Spiders Oil and Gas ETF. And you can see that's moved down over the last couple of weeks, which is good, right? We didn't want this thing to move higher, and obviously we kind of sold it right after it made this big rally up. So as it continues to move lower, that's obviously going to allow us to keep this credit, and it did allow us to keep this credit that we received. Now, because we had sold a broken wing butterfly, we had actually skipped a strike originally with the first trade. So with the first trade, we had actually skipped this 80 strike right here, and we were long the 81 strike. So we had the 78, 79, 81 on the butterfly. By buying back this embedded call spread, which is not really there, but it's kind of psychologically, or I don't know if psychologically is the right word, but it's kind of inside this strategy, you can have an embedded call spread. But by buying this back, where we bought the 80s and then sold out of the 81s, which was our trade, we now create a very perfect and very even butterfly around 79. So a 78, 79, 80 butterfly. And the profit loss diagram looks like this, meaning that we have everything centered and pinned basically on the 79 strike. So if XOP does trade higher between now and expiration, we obviously wanted to trade up to 79. But the beauty of this thing is that by adding this back in, or by buying this strategy and making a hedge into this just regular butterfly, we basically have absolutely no risk no matter where XOP trades between now and expiration. We've basically capped a trade off that has no downside risk at all. And you can see that visually on our chart over here on the left-hand side, that there's only profits for us locked in on this trade between now and expiration. And so basically we look to make about what we've already made on this trade right now. So where it is right now, we don't look to make any more. But just in the off chance this is kind of a lottery ticket that XOP does trade up to 79, then we'll have a even bigger profit right at 79. So at the end of the day, this butterfly spread, which we took in for a credit, we're basically going to make the entire credit on this spread, less what we paid on this debit just today or on Friday to get out of the trade, which was about $8. So about $16 that we paid out of here. It's going to be a nice winning position, and obviously we'll go over that again at the end of June expiration. The next trade that we want to talk about today is actually a combination trade, and that is a vertical roll of our current RUT position. So what happened was that we entered a new position in RUT and closed out of our current position on the lower side of the market. So if you remember, we currently have a big wide iron condor going in the rut. And as the market has moved higher, we've been able to now roll up our put side. So as the market rolls towards our call spread, we're not going to touch the call spread side of our iron condor. We're going to actually roll up our bottom side trade, which is the 1,995 put side, and we rolled it up to 1080, 1075. Now, the reason I point out both of these trades together is because they actually were separate orders, and that's how we got them into the market. We closed out of this trade first, and then we re-executed or re-entered this trade. You can do them together as one roll, or you can separate out the trades, whatever works for you guys. It just happened to work for pricing and for at least liquidity to separate out the trades for us. But the reason that I bring these two trades together is because you'll see that we paid a $15 debit to get out of one side, and on the other side we took in a $19 credit. So the actual net of the entire roll is that we took in an additional 75 cents in credit. Now, a lot of people are asking, Kirk, why'd you do that? Why'd you roll up that put side? And the reason that we rolled up the put side is because our call side is getting tested right now. So here's a look at the profit loss diagram for the RUT trade. So you can see that it's a big wide iron condor, even where we have our current strikes right now. And the call side is getting tested on the upper end. As the market rallies, that gets tested. But by keeping the same number of strikes and the same width of the strikes, meaning they're both $5 wide spreads, the one that we closed out of and the one that we resold, we now have no additional risk by taking in more credit. So think of it this way. We have no additional risk than if we had entered the trade originally, but by rolling up the position, we are taking in more credit. So we are either reducing our loss or increasing our potential for profit. So that's exactly why we made this trade and rolled up the call side, or rolled up the put side. Now, obviously the market is starting to really test that call side. It's trading at 1142. Our first strike is at 1140. So we're going to be a little bit more patient because we do have some time between now and June expiration. But if we don't see a significant move back down in the RUT in the next couple of days, we'll go ahead and again roll up that put side to something a little bit closer, maybe something around 1110, 1100 or so, and just keep taking in more credit and more credit and more credit, which will only reduce our loss or increase our potential for a profit on this trade. So that is the RUT roll that we had. Now, the other trade that we closed out of today and just partially was IWM. It's very similar to the RUT. Obviously, it's because it's a lower kind of denomination dollar index to the RUT. But we had a vertical call put spread that we had originally sold in June. This was just a standalone 108, 106 put spread. We closed out of half of that position today. So we still have 2 contracts left, but we closed out of those at a $24 debit. Originally sold them for $50 as a $2 wide spread. So we made a nice $26 profit on each of those spreads that we closed out of. So tomorrow we'll look to close out of the rest of those and at least make money as the market's rallying higher. Now, 2 of the new trades that we got into today are very similar in nature, so I'll just go over those very quickly because we've covered them very similar trades before. But the first one is X, which is US Steel, and we got into the July, so we're starting to move out in expiration month and kind of get away from June options as we've been doing the last week or so and get out to July, giving us a little bit more time. But we bought the 23.25 call spread for a 102 debit. Now, the width of the strikes is $2, and so we like to pay about half of that width, or about $1. And you can see we paid just over that a little bit, and it was just a pricing that we got in the market, so it was actually fairly decent pricing. But we want to see a good move up in X between now and expiration. Now, this is a low volatility trade. Volatility is very low in US Steel. It's down at the 6th percentile, but you can see that it's had a really tough run on here the last couple of weeks. And so what we're hoping is that it's found kind of a base here around 24, and we could see a nice little rally between now and then. So it's already started to rally off the bottom, which is great, and we just want to see more of that type of move. Now, the other trade that we got into the other day is Oracle, and we did almost the same thing, a $2 wide spread on the call side for $1.04, so you can see we paid a little bit more premium than we did on X. And basically the same thing is going on with Oracle that's going on with US Steel, and that's that we just want to see the stock continue higher. Now, Oracle's a little bit different in that we're not buying this thing in a downtrend, so we're actually trying to buy into strength here, saying that, you know, Oracle's continue to be resilient even as the market has had a little bit of tough time in April and May. And so we think that if the market does rally here, that Oracle's going to be one of those stocks that's going to kind of lead the way. So it's going to be a leader in the pack, at least in the technology side, and hopefully we do see that. So we're actually buying into strength here and kind of diversifying the way that we're adding positions to our portfolio.